Investing is a successful strategy to make your money work for you. Almost anyone should do it. There's no reason why not to invest if you want to get rich. It would be unwise not to begin investing because it has a lot of benefits. It will help you achieve financial freedom and wealth. You cannot save your way to becoming a millionaire, so investing is the best way, if not the only way. With this, you continue to make money wherever you go, even when you're on vacation. I mean, who wouldn't want that? Well, investing allows you to do just that. Only a small percentage of investors, though, are aware of the criteria for success. Because of this, I'm going to share 7 strategies on how to approach investing that every investor should be aware of. Welcome to the Wealth Builder Den, your way to financial freedom. We'll help you make good investments and informed financial decisions to build your wealth. Subscribe to the channel. We'll share investment tips and tricks on how to save money and becoming wealthy. Don't forget to click the notification bell to be updated. This will help you avoid wasting any more money. Now, let's get straight into the videos. Number 1. Investing slowly but surely. There's a tendency that after seeing a video or an interesting article about investing, you're already excited as a new investor and willing to give everything you've got. You must, however, understand the secret of every successful investor and begin by starting small. It's fine if you don't understand investing completely, because even today's experts were once newbies. Embrace huge goals, little beginnings, and investing while you learn. Let's think about the strongest man in the world. Imagine attempting to lift what he did to win the title. Lifting heavy or as much as he did on your first day carries a risk of injury. Even he initially began by using light weights. It's only possible when you train consistently with time. Investing follows the same logic. Being a successful investor does not happen overnight. Investing big at the beginning puts you at a higher risk of losing it all. So it's best to wait until you are confident enough that you have enough knowledge from those accumulated small steps. By learning the fundamentals of investing, you can only get better over time. Most large companies now had little operations when they first began, and most large investors began by making little investments while slowly working their way to the top. You should therefore start by making a little investment in various industries. At this point, educating yourself through experiences and research should be your main priority rather than making money. Due to lack of knowledge of the fundamentals, most beginner investors lose money. However, by taking it little by little and lowering your risks, you may learn how to invest wisely by figuring out what sectors to invest in. Keep in mind that the fact that successful investors only make investments in areas they are familiar with is one of the factors behind their success. Risk comes from not knowing what you are doing, says Warren Buffett. Number 2. Invest only what you can afford to lose. First and foremost, every investor needs to understand that there is risk involved in making investments. Simply put, there is a risk when you can't foresee how an investment will turn out. The amount of compensation an investor receives will depend on the degree of risk they are willing to take. To put it another way, each and every investor is aware that there is no guarantee that they will receive their initial investment back. You should also be aware that investing doesn't make you rich overnight. It could take years. Being patient is one of the most crucial qualities an investor needs. When you've put more money into something that you can't afford to lose, it could be tough for you to be patient. Investors begin to panic at that point because they anticipate seeing immediate returns. You won't multiply your money right away, so don't invest more than you can afford to lose. If you're not thinking of owning a stock for 10 years, don't even think of owning it for 10 minutes. says Warren Buffett. Once more, investing more than you can afford to lose increases your risk of making poor investment choices. I'll guess that at least some of the top concerns you have right now involves money. Unknowingly, to the vast majority, there is a stronger connection between money and our emotions than we might think. Therefore, if you invest beyond what you can afford to lose, it's possible that you'll feel anxious and make poor choices. What would you do? For instance, if you invested 100% of your capital and the next morning saw that the market had dropped 10%. The bigger the investment, the bigger the loss. You would probably panic and sell your investments because this is the only money you have, hoping to stop additional losses. Successful investors, however, are aware that downturns are a normal part of the market. And this brings us to the following strategy. Number 3. Consider the downside of investments. Reds and greens can be seen on stock market charts. The majority of investors favor green since it suggests they will make money. But they despise red because this tells them that they lose some of their investments. Gains cannot, however, be sustained with no occasional drops in performance. There are histories of market downturns, but one crucial fact you must be aware of is that investors who held on during these periods ultimately regained their investments back or even more. Investors with experience know that a market decline gives them the chance to buy more assets at lower prices. In order to prevent losing money, you should refrain from selling your investments during a downturn. In the event that you purchase a stock at 100 and sell it at 75 during a decline, for instance, you're then down 25% from your initial investment. But if you keep it for a while, ultimately, the stock's value will rise and you'll make money when that happens. Number 4. Take advantage of market crashes. Some investors experience major disappointment when they lose money, thinking they did adequate research before making the investment. But nobody has control over the market. And even the most successful investors occasionally make mistakes with their projections. More improvement will happen the sooner you realize that losing is an inherent part of investing. Utilizing losses to your advantage is a crucial investing strategy that you should be aware of. Recognize that nobody has complete control over the market and make failures a learning step toward your success. Even the most accurate projections could be inaccurate, costing you money. Additionally, you should avoid ignoring your errors as an investor. Take time and think about them. Make a list of the issues you believe occurred and consider potential fixes. To just avoid similar errors in the future is insufficient. They must teach you something as well. Indicate, for instance, if you purchased a stock as a result of reading information from an unqualified financial counselor on a forum. Avoiding the forum might not be the answer. Instead, perform your own investigation and verify the content you trust. Diversifying your portfolio is another strategy to profit from losses. You must also invest in various industries rather than just different companies in the same industry. For example, since Apple and Microsoft are both part of the same industry, there is a good chance that what happens to one will also likely happen to the other. You may invest in both a tech and a healthcare company, for example, to distribute among them and lower your risk. Again, to increase your own chances of success, don't rely just on your own assumptions. Instead, seek out the advice of professionals who have a track record of achievement. Number 5. Try not to be overly greedy. Naturally, most of us are inherently greedy. Although it's challenging to accept it's the reality, it's not bad or wrong wanting more for ourselves. However, managing your greed is another crucial investment strategy that you should be aware of. Some investors are constantly searching for trendy stocks with significant profits. However, the majority of investors actually lose money while making such bets. One of the most popular quotes of Warren Buffett about investing is, "Be fearful when others are greedy. Be greedy when others are fearful." This suggests that you shouldn't let other people's greed affect the way you decide to invest. Typically, only those who invested first profit. If you've experienced FOMO, or fear of missing out, you're probably going to purchase an overvalued stock, which might end up in the loss of the money you invested if the stock declines. As a result, you must exercise extreme caution when investing to avoid losing money despite believing you have made it. Moreover, this is not intended to suggest that every popular stock that indicates a high return is a bad one. You should be aware, though, that if an investment seems too good to be true, there's a high chance that it is. Therefore, before you make any decisions, you should conduct a thorough analysis and research all there is to know about a certain investment. To make a profit, keep in mind to have an objective before investing to control your greed. Number 6. Safeguard your initial investment. This also means protecting the principal investment. The inability of new investors to preserve their capital is another factor that contributes to their failure. Put simply, Warren Buffett once remarked, Rule number 1, never lose money. Rule number 2, don't forget rule number 1. This means that if you want to succeed as an investor, follow their example and avoid losing money. Now you might wonder how it is even possible to invest and not lose money. Yes, you can accomplish that, and I'm going to demonstrate how. Before making an investment in a certain asset, every excellent investor has a plan. They refrain from becoming greedy if their prediction comes true and their asset's value decreases. Even if the asset's worth appears to be rising endlessly after they have accomplished their objectives, they don't feel tempted to hold on to it. They keep their initial investment while keeping the earnings. As a result, you must learn to safeguard your wealth as a beginner investor by taking profits as your portfolio grows. Keep in mind that nobody can correctly forecast the market. Protecting your capital, on the other hand, will probably make you less concerned about the direction the market takes, which will allow you to earn more money. Number 7. Don't focus on your regrets and stop wishing. Have you sold a stock too soon that caused you to miss the rise? Despite your thorough research, there will still be instances when you make choices that will have you wishing you had done more or better. I wish I had purchased more of these assets earlier. I wish I hadn't sold what I did at that time. I wish I could be more patient. You don't need to waste time imagining what may have been. We'll put it another way. What if after purchasing the shares, the business failed in a few years? How would you respond? What if you held onto the shares and they eventually lost all of their value or the market crashed? So you can see that it is useless to think about opportunities that were missed. You should instead concentrate on what you already have and how to create future investments that will pay off. Again, if an investment appears fantastic, it's acceptable if you fail to make it. Regardless of the potential financial rewards, if you don't firmly believe it in the first place, investing in it is generally not a wise idea for you. There's always an opportunity waiting for everyone at their own time, provided that the market is accessible to us. If you're fortunate, you might invest in an IPO that becomes the next tech giant or big company in the next following years. Now, I hope you guys learned some useful information from this video. We appreciate you for staying till the end. Let us know what you think in the comments section below. Kindly click the like, subscribe, and notification bell icons if you think this video will help you in your future financial decisions. Visit our channel for more financial knowledge, building your wealth, and investment tips and tricks videos that you don't want to miss out. Have a great day and see you in our next video.